sir. There's a GC right there, Cliff.
Go.
It's piers. We got concrete piers and wood piers.
Yes, sir.
Checklist. Let's check out the checklist. We
Yes,
got it for everything we need.
Yes, sir.
You forget some things sometimes. So this is going to outline, make sure you hit every single thing. What's the foundation, plumbing, electric, painting, flooring, everything. So you don't miss anything.
Okay.
You want to make sure you get all your checks.
Okay. Y'all want to introduce you guys to Cliff Hunter. Cliff is a world-renowned flipper. He actually flips. He's also a GC as well. He's a good contractor. When it comes to all of our renovations, all over the nation, you'll talk to this guy right here.
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partner Dale back in the saddle again for another edition of Real Estate Friday Live, which is now called The Investor's Edge, guys. Good to see you guys. Thank you so much for guys. It's just going to be me today. Cliff took care of some business for us, guys. If you could do me a favor, guys, like, share, and subscribe, guys, if you don't mind, please. And if there's a little bit of bell on the platform that you're looking at or something, no, don't you worry about it at all. Click on that thing so when your partner and Cliff comes live, you get to see us. All right, guys. But guys, let's dive into this thing real quickly, man. Real quickly, guys. Normally go through the current market analysis, but I'm not going to do that today because me and Cliff do that together. Let's dive into our topics today, guys. Here we go. Our topics today, guys, is going to be very simple. Man, I'm going to get rid of this number first. Guys, we're going to talk about the Fed latest rate cut. I'm going to go a little bit deeper on this one, all right, guys? Number two, man, I call him an OG of real estate, is talking about interest rates will go down to 0%. What? Yes, sir. Also, maybe a rental explosion and crypto. Man, crypto in lending, guys, in lending, right? That may go hand in hand to this interest rates going to zero. This is what a OG real estate. He's one of the GOATs, guys. And lastly, man, there was an election earlier this week. Zoran Mondani is now the new York City mayor, and he has one policy that I think goes right in tune what we talk about is New York City's rent control. And we're going to talk about the investor's edge that you actually get because of this policy. There's a strategy, guys, that you're going to want to learn about today that because of this bad policy, what's going to happen in NYC, New York City, that a lot of investors are going to take advantage of. I won't be one of them because I will never invest in New York. It's just me. It's just me, guys. It's just me. But at the exact same time, guys, there is a strategy, guys. But let's dive into this thing, guys, real quickly, man. If you don't mind, guys, let's go. First and foremost, let me get to it, guys. Forgive me, guys. I'm going there. Of course, there was a rate cut about 9 days ago by your boy. I call him the most politically expedient Fed chairman in history, Powell. He came out and talked about it a little bit as well, guys. I'm gonna give you my commentary on this again concerning what he's talking about real quickly, guys. And then we'll dive into it, man. Here is the most politically motivated Fed chairman of all time, Chairman Powell. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Okay.
Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1.
That means there was no quantitative easing.
I will have more to say about monetary policy after briefly reviewing economic developments.
Stop right there. That should be where he stopped. Right there. His sole responsibility is monetary policy. Watch how this man pivots. Here we go.
Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists.
I agree.
But these effects should reverse after the shutdown ends.
Agreed.
In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
And I believe the 2% goal is a farce. It's farce. It is a farce. 2% goal for inflation is trash. They know it. This is a game.
Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation.
No. Why is this Bama talking about tariffs? That is a presidential authority. Now, you can offer commentary on this, but you are the Fed chairman. Why is he talking about tariffs? And tariffs is not passed on to the consumer because, and I advise you guys to go watch Mark Moss. He does a great breakdown of how on the production and service side, what's happening is the production and service side, they're eating up a lot of a majority of the tariff costs. Why? Because in the middle, the distribution stage, which is the Targets, the Walmarts, things of that nature, they understand that they can't sell these inflated goods to who? The consumer, because the consumer can't afford it. So what they're saying is, hey, service and production people, figure this out. Eat most of this cost. And they're sharing that burden. So again, why is he actually talking about tariffs for? That is not his role. That's why he's called the Fed Reserve Chairman. Let's keep going, guys. Almost there.
A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level.
So he's talking about how tariffs is adding to the inflation. It is not. It is not. That is your projection there. He's been saying this for the last 3 or 4 times about tariffs could add to inflation. It could. I mean, my God, the first time he came up, rocking with you. The second, third, and fourth time, no, because the first time you did it, there was no evidence, there was no data for you to, well, I would say a track record for you to kind of say, you know what, maybe this is kind of adding. So I can understand it on the first, maybe in the second time, but third and fourth, fifth time, come on, bruh. Like, this is getting ridiculous. This guy's the most politically motivated chairman I've ever seen. This is the reason why, in my opinion, he will not step down, because he understands that President Trump cannot fire him. He cannot. He has to serve out his term, which ends of May of 2026. And he knows this. This is why he has not stepped down. This is ridiculous.
But it is also possible that the inflationary effects could instead be more persistent.
Possible.
And that is a risk to be assessed and managed. Our obligation.
He's been saying the same thing all year long. Possibly, maybe, it could. All of this hedging the whole damn time. This guy's trash. He garbage. You and I could do a better job of being the Federal Reserve Chairman. All this projection. What is this mess? Sit your ass down, man, and just talk about monetary policy, not your projection on when it comes to domestic and international policy. That's for the executive branch. And brother, you're not a part of that. You're not a part of the executive branch. You're not. Sorry. You're not the president. The president is the executive branch by himself. You're not him. Stop it. This is ridiculous, man. Get on my damn nerves. Now watch this, guys. Now I'm gonna bring up another video from CNBC really quickly here, guys. Again, we believe in what? Facts and data and receipts. Here's CNBC. Let's bring them in real quickly, and they're gonna talk about what actually happened. Here we go.
The Federal Reserve cutting interest rates by a quarter point to a new range of 3.75 to 4%. There were 2 dissents on this. The second one by new Fed Governor Myron, who wanted 50. First one by Kansas City Fed President Jeff Smith, who wanted no change. So dissents on both sides, a kind of a rare occurrence for the Fed. The Federal Reserve announcing it is stopping quantitative tightening or the roll-off of its balance sheet as soon as December. All roll-offs of treasuries from here on out and mortgage-backed securities on the Fed's balance sheet will now be invested into T-bills. It's a bit of a change there. On the economy, the Fed said economic activity expanded at a moderate pace, according to available indicators. One of 2 nods in this statement to the absence of data by the Federal Reserve. It had said in September that the economy was moderating, so almost a bit of an upgrade to the economy, but according to available data. Job gains, it said, has slowed, however. Unemployment remained low through August. And again, it said more recent indicators are consistent with these developments. That's another nod to the idea that the Fed doesn't really have the official data. More recent indicators is what it's using. Inflation, it says, has moved up since earlier this year and remains somewhat elevated. That is the same characterization as September. And there's not much in the way of forecasting the future path of rates. I believe that'll have to wait for the press conference from Fed Chair Powell. But again, the Fed cut.
So right there, I wanted you guys to see that, how even CNBC is saying, he's saying the same thing he said before in September. The same thing. The same thing. This guy is politically motivated. He needs to go. He needs to go. Trash. Horse manure. Garbage. I can't wait till this man is gone. This guy is a straight joke. He's a straight joke. Respectfully. He's a joke. A joke. 1,000%. All right, guys. So we're done talking about this buffoon. All right. Let's go on to the next topic, guys. All right, guys. Now, one of the OGs, baby. He's an OG, is what I call him. His name is Grant Cardone. That's his name. Hey, this guy owns $4.5 to $5 billion worth of real estate. I don't care what you think about Grant Cardone. He is one of the GOATs. If you don't believe it, shut up. If you say he's not, you are broke. He's not. Okay? Just keep it 1,000 with you. Okay? I think that Pace Morby's a GOAT, right? Robert Kiyosaki is a GOAT, right? And Grant Cardone's a GOAT. These guys are GOATs. Okay? Not based on theory, based on case studies. All right, guys? These guys, I own a lot of real estate, but these guys own a lot more than I do. So again, I'm taking what they're saying. Now, before I go to get into him, guys, really quickly, I want to play a video to point to a problem that we're seeing. A problem, okay? And this is what's kind of sparing him to say what he's about to say, guys. All right, so let's bring back on CNBC real quickly, and we're going to talk about what's going on with these mortgage rates. Let's get it in.
New red flag in the housing market, mortgage delinquencies. It's a sign of bigger trouble ahead. That's the question this morning. Diana Olick joins us right now with more. Diana, good morning.
Good morning, Becky. Yeah, mortgage delinquencies are still historically low because home values have gone up so much in the last 5 years. But early this year, they began to rise just on FHA loans, which are generally used by lower income borrowers. But now we're seeing something new. In May, a significant jump in the early stage category of all delinquencies. That's 30 to 59 days past due, and according to a new report from VantageScore. They rose from 0.92% in April to 1.03% in May. Not huge, again, but an early indication of financial stress among borrowers. What's more concerning, though, is that these delinquencies were led by borrowers in the near prime, prime, and super prime segments. That is, the least risky borrowers with the highest credit scores.
Whoa, that part I want you guys to see right there. I understand that some of this, guys, is earlier in the year, and that's fine. But I want you guys to see it was led by prime borrowers with highest credit scores. Let me say it again. 700 plus credit scores. They have a higher delinquency rate. Let me say it again for the back row. People that have the highest credit scores. It's right there, guys. The highest credit scores. They actually have mortgage delinquencies. Isn't that crazy? I want you guys to see that, guys. Let's keep it going. We ain't done.
So that suggests that this short-term financial stress is possibly beginning to affect even them.
Yes.
And a separate report from ICE Mortgage Technology looking at overall delinquencies showed them rising 5.2% in May from May of last year, with the most serious delinquencies, those more than 90 days past due, up 14%.
Wow.
Again, delinquencies and foreclosures are still at very low levels. But as more consumers face financial challenges and as it gets harder to sell a home, which it is now, these numbers could get worse. Becky?
So again, guys, I want you guys to see that. I understand that it was in May, earlier on this year, but I want you guys to really pay attention to this section right here. The borrowers with the highest, you ready that, credit scores are the ones that are in early stage mortgage delinquencies. Highest credit scores. Okay? Why am I saying this for? The reason why that's so important, guys, is because of the fact that remember back in the day, guys, I was telling you guys that people manufactured pay raises by borrowing more on their credit cards. That added another liability to their bottom line. So now they have, of course, the car note, they have the mortgages, they have any school tuitions if you're going to private school or college. They have other bills, household bills, water, gas, electricity, HOA fees. They have all these other fees. Now you add another bill on top of there at an inflated amount because the interest rates on a lot of those credit cards anywhere from 8 to 20 to 25%. Right, guys, depending on what it is. Hey, what's happening now? People are choosing what to pay, what not to pay. Right? That's what's really going on, guys. I want you guys to see that. See that, guys. This is for real, guys. This is for real. Okay, whatever. All right, guys. So now let's bring in our partner real fast. Grant Cardone. All right. Let's bring in. I call him Uncle G. Uncle G is what it is. And I said it right now. I'm gonna bring him on my podcast or go on his podcast, and I'm going to interview this cat, man, ask him a lot of questions. Man, this is Uncle G. It's what I call Grant Cardone. He went on the show. He's talking about how rates could go to 0%. What? And the rental explosion, guys? What's going on? How are you doing, big time? It is what it is. Let's get it in. Also, guys, I want you guys to follow Social Media Insurance Bro. The reason why is he talks a lot about a instrument that you can use right now to assist you in growth. Right now. So again, follow this young man because he gives great information, brother. Great content, great wisdom. All right. Here we go. Let's just dive into it. Here we go.
So there's a lot of things attracting people down here. And most of it is not pro-Florida. It's basically, I got to leave Chicago, Minneapolis, New York, New Jersey, and Boston because they're going crazy here. Even the Democrats are coming down here.
Well, you've argued, going back to real estate, you've argued that in the future, more and more people will be renting more than owning. Do you still hold that view? And if so, how are developers reacting, responding to this trend?
Well, look, this is the great change today, right?
Yeah.
When I was a kid growing up, I'm a little older than you. But when I was growing up, if you were a renter, it meant that you were poor. Today, 11% of millionaires rent.
Yes.
They choose to rent.
That's correct.
It's about 4 times greater than it was 5 years ago.
That's correct.
It's exploding, the number of people that actually choose to rent, not because of economics, but because of mobility and because of amenities.
He is spot on, guys. The reason why is you're paying less right now in rent than what you're paying in a mortgage. Now, why is that? It's because property taxes have exploded. Insurance costs has exploded. At the end of this podcast, I'm going to talk to you about a solution for at least the insurance portion. All right, they can bring that cost down. But that is the reasoning why you actually have so much going on there when it comes to millionaires renting homes, because they're waiting for rates to come down a little bit more. But I want you guys, so he's right about that, but I want you guys to pay attention to what he says about the 0% interest. Here we go.
We have a project right now we're finishing fundraising on called the 101 Meisner or 10X Meisner Boca property. We combined Bitcoin with that asset. It's the largest real estate purchase in Boca this year.
Wow. And
the largest real estate Bitcoin fund ever done on the planet. The average tenant there, or the average resident, makes over $500,000 a year, David.
Yep.
They're wealthy people.
Yep.
Half of them are from the Northeast, by the way. They came down here from New York City. They probably lived in one of those red brick buildings that was built in 1950 with maybe a little tiny view. And they moved, they were paying $6,000 a month in New York City for 600 square feet. They moved down here, they get 1,100 square feet.
Correct.
They pay $4,500 a month.
Yep.
They save money.
Yep.
They have views of the golf course, $40 million homes in the Atlantic Ocean, and every unit has a view.
Yes.
So these people are moving down here and choosing to be renters. Then you have people your age, the young, the alphas, the betas, the Zs, the Gen, whatever you guys call yourself. What Gen are you?
I think I'm a millennial. Yeah, I'm a millennial.
Yeah, you're a millennial. So you guys are like, I don't want to buy a house. A house is not what I want to buy. I want to be able to travel. I can't afford a house maybe, or I want to travel, or I haven't settled into my career yet. I don't have a family yet. So I would rather rent for 10 or 12 or 15 months and then figure out what I'm doing with my life. So you have 1/3 of the population that's baby boomers that doesn't need to own a home, 1/3 that's the youth and they don't want to own.
Correct.
And I think we have a flip model where we end up with 60% renters in America and 40% owners.
He's right.
Well, I think you've said before, and correct me if I'm wrong, I'm paraphrasing here. Cash is trash. Real estate is freedom. But with interest rates this high, has the game changed?
Well, rates are coming down right now, dude. Like 2-year, the 3-year, the 5-year, and the 7-year, and the 10-year are all hitting lows right now.
That's
I think the 10-year hit a low from last April. Donald Trump, and I've been saying this for a while now, he's replacing the Fed. He's going to get his team in.
Listen.
He's going to get rid of Jerome. In fact, we hadn't heard from Jerome Powell since Trump visited the White House and called him out for spending too much money on that expansion he's doing. We haven't heard from Jerome Powell in about 45 days. He'll be gone in May. Interest rates will be 0 by June of next year.
Did you hear what he said? 0. Let's listen.
My prediction.
Interest rates on what exactly?
Interest
the mortgage
rates,
rate?
No, mortgage rates will be somewhere under 3.5% by June of next year.
So you think?
So what he's saying is the interest rate's going to be at 0 for the Fed rate's going to be at 0, but it's prime plus 2%, maybe 2.5%, 3%. So it's going to be under. He said it's going to be under 3%. Watch.
Whoever Powell. Sorry, you think whoever
we're going
Trump puts in
we're
the
going to
Fed,
get as close to 0 as Trump can get them.
Wow. what that
They're going to fall off a cliff, man.
Now, here's the reason why he's saying that, guys. Real quickly. Why he's saying it is because of the fact that remember what he just said. He said that Trump is trying to replace the Fed. Now, how? Guys, do me a favor when you can. If you have some time, just to kind of shoot the breeze. If you want to learn something, go look on our YouTube on the YouTube channel, all right, or Rumble channel, right. And I want you guys to look for a previous live that I talked about cryptocurrency, right. When it came to the Secretary of Commerce and Treasury, and also Mark Mars, all right, and we're talking about how crypto could cut mortgage rates. Remember what he said? He said that Trump is trying to replace the Fed. Now, how? Remember, the federal government used to be at odds when it came to cryptocurrency because cryptocurrency is decentralized, right? But the government normally in the past wanted centralized power. With this Genius Act, which was created the stable coin, what Trump actually did was he created two reserves, right? He had a Bitcoin reserve and also a stable coin reserve, other cryptocurrency, what that was for, right? Now, he also wanted the banks, right, to create their own stable coins. And the Federal Reserve would actually back it, right? So now get this. What that allows for them to do is to create money via leveraging against the existing cryptocurrency, right, which allows them to expand the money supply without expanding the money supply, right? Let me kind of prove it to you real quickly. Let me bring another cat real fast. He talks about this real quickly, and this is what Grant is saying. Grant is saying that's what he's talking about. Grant is talking about how that is going to be the catalyst that's going to shoot it down to 0%. It's going to be Trump basically mimicking what the Federal Reserve does by what? We have the Federal Reserve, or the Federal Reserve, that would actually has the reserve of cash, and then they flow that cash through the banks, and then the banks then loan to us. In the cryptocurrency thing, it's the same thing. You have two reserves, Bitcoin and cryptocurrency reserves, right? Flow through the banks, allows them to create more money. It gives them the ability to spend the money supply by creating new debt without printing or printing the money supply. It's a very easy concept. It's modern monetary theory because they are not going to pay the debt off. They can't. Let me let you know why. You heard that we are $37 trillion in debt. That is a lie. It's more. We're over $100 plus trillion in debt because in that $37 trillion figure, Medicaid, Medicare, and Social Security is not included in those numbers. Those are liabilities. So we're over 100 plus trillion in debt. There's no way that even with what Doge was doing, even with tariffs, they're going to be able to generate enough income, right, revenue, to pay down that debt. So what do? Simple. What you do is you inflate the debt away, right? You inflate it away by digitizing the dollar. This is the reason why you have this cryptocurrency thing. It's modern monetary theory. That's all it is. But here's what we're talking about. He was talking about how he's replacing the Fed, but this is what's going to happen when it comes to the cryptocurrency reserve side. Here we go. Let's dive into it.
10 years time, you've got $1.8 million sitting in Bitcoin. You can now borrow up to 50% of the value of that Bitcoin.
Stop right there. Borrow.
So you could borrow out $900,000 from the financial institution. And here's the benefit with doing that. One is you're not selling the Bitcoin, so you're still going to keep exposure to the market because it could still go up. And as you can see over that up to 20 years, it's going to go up to $32 million. So why would you want to sell the 1.8 million and miss out on the potential gains? So you keep the Bitcoin, and by keeping the Bitcoin, you now don't have to pay any capital gains tax. And by borrowing the $900,000 or up to $900,000 on that Bitcoin, that is a loan. So that is now not treated as income. So again, is not a taxable event.
Stop right there, guys. You see that right there, guys? They're allowing you to borrow up to 50%. That's a great leverage point for asset called cryptocurrency, which means you'll never over leverage yourself because it's equal. 50%. They even maybe going 40%, 45%, right? So you're not forced to sell. No capital gains taxes, no taxes. You can leverage it, you borrow against it, and do what you would normally do by selling. So you keep an asset on your balance sheet, which makes you bankable, but also you have access to capital, which makes you more bankable. You can go ahead and make more investments. Hello, McFly. This is what he's doing. That's what he's doing, guys. This is not hard to understand. Not hard to understand at all. Someone said, "I hope you are right. Hope he right about the rates because I'm ready to refinance." It's something. It's something is telling me to wait. Yes, wait. Yes, just wait just for a little while. They'll go down a little bit. But I would say when you refinance, I don't know what position that you are in when it comes to your debt. I don't know if you own it free and clear or you owe some debt in there. You're refinancing, so I'm assuming you owe some debt on the property. I would say, yep, depending on how much, I don't know what position you are, but if you want to leverage it, a little less leverage so that you're not over leveraging yourself, that'd be great. I don't know. You may want to do rate and term, but if you bought your property between 2022 or and above, you're paying a higher rate. So you probably go from probably a 6-7% interest rate down to maybe a 5.5% interest rate, which is a nice haircut for you. And to be honest with you, the rates. This is what I disagree with Grant on this year. Okay, I don't think the rates are going to go down to 2 or 3% as far as the retail rate, not the Fed rate, the retail rate, right? Because we held it at under 2%, 2 to 3% too long. The sweet spot is between 4 to 5%. That's the sweet spot right there. I think Grant's selling. I think Grant understands that by him saying 0%, that gets eyeballs, whether people that are for him or against him, and he gets to talk a little bit more. And I respect the hustle. I respect it. He said, I owe some debt, but I am a 7-year. Oh, okay. 3.7. Okay, that's good. So how far along are you on that arm? Are you at the beginning, middle, or close to the end? How close are you to that arm? Because 3.75% is low. And you may, depending on what leverage point that you're at, right? If you have some room equity-wise, when you refinance, you may want to buy down that rate so you can get close to that 3.75%. Because you're going to go up on the rate. You are going to go up. You are. Probably about to 4.5%, 5%, which is not a bad uptick at all. But if you have enough equity, you can buy down the rate to where you can get back down to that 3.75%. Beginning, okay, good. You're good. You're good. So here's what I do is I don't know what your LTV is. Good stuff. Less than 6 months. Gotcha. At the beginning, less than 6 months. Yeah, less than 6 months. Yeah, that's good. Let me say yes, maybe a cash out refi. Yeah, but I would say, Alonzo, what I would do if I was this person is you'll probably go from a 3.75 to maybe a 5.5% or 5%, depending on your banker or your bank. I would, if you have enough room, I would see if you could buy down that rate to get back down to 3.75% or close to it. Right? Now, if you need the cash, take the cash and do what you need to do with it to make sure you can sustain the debt. Right? But if you don't need the cash and you can afford to buy down the rate, buy it down. Get down to 3.75%. At a little bit of a higher leverage rate, you probably won't even feel it, your payment will go up a little bit, but not that much, right? That's what I would do if I were you. This is my advice. Take it or leave it. All right, guys. Now, guys. Now let's go a little bit deeper, guys. A little bit deeper, real quick. We're almost done here. Now, guys, let's go a little bit deeper. Now they are already, guys. They are already allowing for you to pay. Buy real estate with Bitcoin and pay your mortgage with Bitcoin. You don't believe me? Watch.
Virtual tours to online mortgages. There's been plenty of tech and innovation in the housing market lately. Now you can add Bitcoin to the list. For the first time ever, some home buyers will have the option to pay for their mortgage with the coin. CNBC.com's Mackenzie Sigalos is here with more. Mackenzie?
Yes, sir.
Hey, Kelly. So potentially as soon as Q3 of this year, you could be paying for your mortgage in Bitcoin and eventually in Ether. United Wholesale Mortgage said this week that it has plans to accept cryptocurrency for home loans. Now, the CEO made the announcement halfway through the company's earnings call, and he's billing it as a first for the mortgage industry here in the U.S. I spoke with the team there, and they say that they're thinking about starting with Bitcoin.
United Wholesale Mortgage, they are a warehouse lender. So basically how lending works, guys, is fairly simple. Typically when you actually go buy a property or you go borrow the money to buy a loan, to buy a house with a loan, typically a originator will give you that mortgage, right? And then they'll sell that mortgage on the secondary market, right? United Wholesale Mortgage is one of those originators. They're the ones that actually use what they call a warehouse line of credit to fund your mortgages. And then what they do is they make sure that you qualify for the secondary lender when they sell it off. This happens whether you are an investor, you're buying in the investor pool, or you are a retail buyer. It happens either way.
But they're actively in the process of evaluating other digital currencies. To put this into context, it's actually a pretty big deal. UWM is the nation's second biggest mortgage lender after Quicken. They had $59.2 billion in loan volume last quarter. But also really important to keep in mind here, this push into decentralized digital money comes at a time of heightened scrutiny of crypto from all sides in the U.S. We've got revamped crypto tax rules as part of the $1 trillion infrastructure bill, not to mention the fact that top financial authorities like Janet Yellen and Gary Gensler have recently been weighing in on the question of whether to regulate cryptocurrencies. Kelly?
I'm just going to ask the question.
So stop right there, guys. Guys, yes, you can pay for your mortgage via crypto, but this person here, I agree with what this person is saying. Don't do it. Don't use the BTC, which is Bitcoin, for that unless there's absolutely no choice. I agree with him. I would not be using any silver that I own or gold that I own to take care of bills unless it was the last line of defense. This person is right. Follow this counsel. Spot on. Don't do it unless it's your only choice or your last choice. Don't do it. He is right. He is right. Or she. Great wisdom. Great counsel. Great counsel. All right, guys. Guys, I'll be right back, guys, and we'll dive into the crypto to the last thing we'll talk about, guys. I'm gonna take a little bit of a break real fast, guys, and I'll be right back. Here we go.
What if you could help families lower their bills and get paid for it? Healthcare premiums, insurance rates, and loan interest just keep climbing higher. And most people just keep paying without knowing that there's a better way. We use a fintech platform that connects people to lower healthcare costs, competitive auto and home insurance, better loan products, higher yield bank deposits, and even ways to cut energy costs, all in one place. It's the same technology that banks and big corporations use currently. But now entrepreneurs like us can leverage this technology to build an income stream and help others save. Take our 30-second assessment to see if this business model is a fit for you. Click on the link, watch the short video after, and let's explore what's possible.
All right, guys, we are back. We're back. Thanks so much for that break real fast, guys. My man. Good stuff, man. Hey, brother, great counsel. Great counsel. Again, let me put up here again. Don't use Bitcoin unless you absolutely have no choice. He's spot on. Great counsel. Awesome counsel. Keep coming with the thing. Now, guys, let's dive into the serious thing we got. There was an election in New York. And they now have a new mayor. His name is Zohan Mamdani, right? He has a lot of wild and ridiculous policies that don't make no sense at all. One right now is called rent control. Rent control. All right, guys. Let's dive into this real quickly, guys, and then we'll be done with the show. Let's get it in real fast. Here we go.
Paying too much on rent.
Rents rose a record 11% last year.
It is extortion.
Activists want to fix that, so both Minneapolis and St. Paul voted for. And St. Paul voted for
the most stringent measure in the country.
This is meant to curb extractive rent increases, unfair profiteering.
It's predatory practice.
Those are powerful words. But what do the words mean? Profiteering? Profits are what persuade people to build things.
Correct.
When profits are high, other builders rush in to grab those profits. Soon there'll be more housing, and that will lower rents. That's just how markets work.
Correct.
If we have less supply, prices go up.
Cecil Smith of Minnesota's Multi-Housing Association.
We need more supply. We need more housing.
But studies show rent control reduces the supply of
Correct.
rental housing. Activists don't want to hear that.
We don't need more studies. We don't need to collect more data. We need action now.
St. Paul's actions were uniquely strict.
Many cities exempt new construction. St. Paul's ordinance would not.
It's the most draconian rent control that anybody's ever imagined.
This is such a step backwards.
Mercatus Center economist Salim Firth studies housing.
What St. Paul is doing is actually going to hurt renters because they're going to have fewer choices. The market's going to shrink and quality is going to fall.
St. Paul's mayor voted for rent control, but now has second thoughts.
Turning off our supply of new housing would be disastrous for us as a community.
The mayor voted for it, but now he says, wait a second, we shouldn't apply this to new housing.
Yeah, because he knows that it's just absolutely going to shut down construction. Every rent control ordinance that even lefties have supported has had an exemption for new construction because everybody understood that if you apply this to new construction, you would completely shut it down.
He's right.
Lenders are going to have to look long and hard about financing a project coming up.
If you don't already have a building, why would you enter a market where it seems like the government is actively trying to hurt you? You're providing an essential service, something that human beings need to live. And if the government there is viewing you as a hostile outsider, I wouldn't want to bring any service into a market like that.
In St. Paul, they can just move a few blocks over to St. Paul's Twin City. Although Minneapolis also voted to allow rent control, they've been wary about imposing it.
There'd be a final report by the end of this year so voters could weigh in next year's election. It matters that we take action now.
This city council member is frustrated
Listen
that
to this,
Minneapolis hasn't yet adopted St. Paul's strict rules.
I'm going to keep fighting for a 3% cap with all of you.
I want us to follow their lead.
She's the only Minnesota rent control promoter who'd talk to me. If you're a builder, why would you build in a place where you can't raise the rent more than 3%, which is less than inflation?
If you're a person who lives in this city and you can't stay here anymore, then we don't have a city anymore.
But the way you have a city is if people build apartments and houses.
Correct.
And that's what eventually brings the price down.
In other cities, we have continued to see the development of property continue to happen.
What cities?
In San Francisco, there's continued to be development.
San Francisco? That's a bad example of new development.
Correct.
Builders still build in Minneapolis. Building permits were up 65% last winter. But in St. Paul, they're down 60%.
Wow.
Because of rent control.
Wow.
You're not going to get more apartments by pushing this.
Watch this.
This pause is one of those rare interview moments where silence reveals so much.
I mean,
don't elected officials research issues before imposing government force on others?
No, they don't.
I'm going to maintain that guaranteeing housing for people and making sure that they can stay in their homes matters more than anything else does.
You're a socialist.
Yeah.
Where has that ever worked? Again, the pause says it.
I'm doing a just fine job of representing my community.
Trash.
Rent control is an appropriate tool nationally.
Nationally, socialists believe in rent control too.
Tell landlords that they cannot simply jack up their rents to any rate that they want.
But landlords can't just jack up rents.
They don't set the price. The market as a whole sets the price. The conditions of how many housing units are there, how many people are looking for housing, that's a market. You can't just magic away the fact that more people want to live in your city than you've provided homes for.
That's not the popular answer. Progressives everywhere push for rent control.
Rent has got to go. The people want rent control.
People don't learn.
I live in the only town in Maryland that has rent control. We've had it since the 70s. We have not built a single multifamily building since that law was passed.
The late economist Walter Williams once told me,
short of aerial bombardment, the best way to destroy a city is through rent controls.
Yes. Listen to this, guys. Listen to this.
Rent control once destroyed much of New York City because landlords couldn't make money. Some started fires for insurance, and then
They just let it burn.
and even before the fires, they stopped doing maintenance.
We don't have the water. We have to go outside to get the water because the landlord doesn't want to do.
Uh-oh. Uh-oh. Did something freeze? Uh-oh. What?
Anything in the building.
The buildings were awful. They didn't run hot water pipes.
Landlords just don't reinvest. They don't take care of their properties. They don't send a plumber promptly when water starts leaking.
Today, rents are up, and that's hard. But in the long run, rent controls will only make the problem worse.
What we need to do is build more houses. That is the solution to rising housing costs.
So, guys, I got to say it. Guys, we got to start reading some damn books. All right? But let me put on some music real fast. We got to start reading some books. Because guys, real talk, if we don't, this is what we get. People that don't understand, people getting elected that have no concept of financing at all, how markets work, how economies work. Landlords do not set rates. The market does. But you saw how she actually just paused and did nothing? Just stupid, dumb people. Here we go. Somebody said, rent control is not a good idea. So cities will start falling apart. Investors will sell. Exactly. Money is attracted to, high valued environments. If the local government has rent controls in place, that is not but the market let's say that, for example, it says the rent control says you can only increase your rent 3% annually, right? But the market says 7%. We're losing 4%. So why would that's a bad environment to put my cash in, because you are squashing growth with your draconian mandate. It's trash. It's horse manure. It's garbage. In no damn sense. People are stupid. You see how she just sat there and she is so committed to her ideology, common sense is gone. This is who you guys are electing. This is who this guy's policy is rent control. And they're lying to you saying that landlords are becoming predatory by hiking up rental rates. Horse manure. That's the damn market. It is not the landlords. This is why you have an appraiser and also a realtor who pulls comps and says, hey, the market says X. The landlord didn't say that. The damn market said it. And these people, we're so dumb that we don't even push back on these idiots. These people are dumb as hell. Dumbass people. Golly. Guys, we got to do better with vote people in. And I got to say, on this one, I don't hate to go to political. Republicans, you got your asses whooped. Got whooped in New York, in Virginia, in New Jersey. Got your asses whooped. You did. You did. Trash. Horse manure. Dumbass people. This fool is going to be running New York. This socialist running New York. Ain't no damn sense. Yeah, we gotta do better. And I'm talking to me too. Guys, read a book, listen to podcasts, financial podcasts, personal development podcasts. I'll give you some recommendations. Listen to Precious Swaggerty. Listen to PBD podcasts. Listen to the 7 Figure Squad. Listen to Purpose Over Profits, which is Brian Adamson. I'm giving people that I listen to that's not the mainstream. All right? Listen to those guys. The reason why is because of the fact that you can begin to learn new things, learn new concepts, right? So that you can go into an election season and begin asking questions to these dumb politicians who are getting paid during a government shutdown. How that makes some damn sense? And say, hey, what's going on here? And you begin to vote the buffoons out and get some people that are wise in. The reason why we are suffering is because you have the buffoons running the asylum and wisdom sitting on the sidelines doing nothing. Stupid. We gotta do better. We gotta do better. And we can. We can. And I'm talking to me too. Local government, elections, county elections, state elections, and federal elections. All 4 levels. All 4 levels. If you sit out, stop bitching and moaning. Take it. And New York, you're going to mess around and find out. Mess around and find out. Free bus rides. Free child care. Rent control. Trash. Garbage. Horse manure. No damn sense. I'm sorry, y'all. Forgive me, y'all. I'm sorry. So question, it's a question. Okay, what is the best way to have housing that's manageable for people to live in? Good question. The best way to have good housing, guys, I'm going to say it, guys, because the market dictates the price points. The market does, right? If you are not making enough money, or you have your eyes set on a certain property, right, whether it be rental and or a buying, which is fine, and let's say the purchase price is above your pay grade or is above what you're making now, you're going to have to begin to make more money because you're in an inflationary type of economy. Let me give you an example. When I was a young boy, my favorite piece of candy was Skittles and Mamba, right? I don't eat a lot of candy, but those were my 2 favorite pieces of candy. I could buy a stack of Mamba that it came in a 1 little packet, stack of Mamba back then for 99 cents. That same Mamba right now costs $149, $150, $189. I'm 46. Back then I was 12, 13? And inflation is going to be here forever. So when the market dictates a price point, you're going to have to either cut your expenses down a little bit more, right? And you got to make more money. You have to begin a side hustle. And I would implore you to do that because of the fact that I don't know if you're married at all or people are married here that are watching. I'm pretty sure some of you guys are. What I would say is the Bible says a wise man leaves an inheritance for his children's children. So if you live your life just for you alone, you've lost. You've lost. You've lost. But if you're living for your kids, like I'm right now building businesses, right? Investing, not for me, just me, not for my daughters, but for my daughters' kids, my children's children, right? So when they say, hey, if it wasn't for grandpa, right, we wouldn't be where we are right now. Does that make some sense? I'll give you an example real quickly. When I was buying some property in Starkville, Mississippi, which is where Mississippi State University is at, I was able to sit down and have some great time with a powerful politician there. He was the county judge there, right? County judge, powerful man. But he also owned restaurants and he also owned title companies, right? And then law firms. And he had a lot of pull in that town, in that county. And I'm talking to him about him and his life and things of that nature. And I said, man, how'd you get involved with the title business of that nature? He said, oh, law firms. Oh, he said, this is because of my grandfather. So he is living the fruits of what his grandfather began. Not his daddy, his grandfather. So again, children's children. Now look where he's at. So my question to you is, what are you doing to leave a legacy for your kids? What are you doing? If the answer is nothing, you've lost. I'm sorry, but you lost. Or you are losing. You can turn it around. But to answer your question, cut your expenses, right? Make more money. Build something of your own. If you look at the Elon Musks, the Robert Kiyosaki's, the Warren Buffetts, a lot of their wealth is tied to their assets, right? For example, Elon Musk, his package just got approved by the board for Tesla. It's $1 trillion package. Not $1 trillion in income, $1 trillion in a package when it comes to assets, stock. Stock. He wanted that. He wanted that, guys. Again, he's the richest man in the world. and all of his income, all of his wealth is tied to his businesses. Outside of your 401k, what do you have? Or your real estate, your home property, what do you have? What do you have? If the answer is nothing, it may be time to pivot, right? It may be time to pivot. I hope I answered your question. I gave you some wisdom. I hope I did. If I didn't, just let me know, and I'll go a little deeper if I have to. Because I'll say this, guys, and then I'll be ending. I'll end real fast. Real quickly here, and then we'll go to this. Is called the investor's edge. All right. One of the strategies that's going to come out of this, guys, out of what's happening in New York, guys, is this here. Is whenever you put in rent controls, guys, it drives out investors, right? And what happens is now you get a lot of what they call dilapidated or distressed assets, properties in New York, right? And what happens is you see a decline in the economic environment in New York City. Now what happens is they have to change their policies, or they're going to destroy the entire city. That's what normally happens, guys. Then smart money comes in, and they're able to acquire these properties for pennies of dollars, and sometimes even free. Yes, those investors that are ready, when the time is right, are going to be able to go back into New York City and buy so much properties with more friendlier policies. You're going to be extremely wealthy. Wealth is never destroyed. It's merely transferred. It's never destroyed. It's merely transferred. Here's my question. When was the last time wealth was transferred over to you? And the answer is never. Change that reality. Change it. I'll give you 3 disruptions, right? The first one was the back in the 80s was the long distance disruption. I know a lot of millionaires that came because of that wealth transfer, right? Number 2 was the energy disruption in the 2000s, right? The deregulation thing. I know a lot of millionaires that there was a significant wealth transfer there, right? Because of disruption, right? And then, of course, right after that was the mobile phone disruption. I know a lot of millionaires that made millions because of that wealth transfer from that wireless disruption. Do you get the picture now, guys? When there's a disruption, right? Wealth is transferred. For instance, there's one going on right now. Right now, guys, is the AI or fintech disruption. Fintech stands for financial technology. That disruption is here. So what are you going to do to take advantage of it? Right? Fintech just means financial technology. That's all that means. Here in a second, I'm going to show you something real quickly, guys, of this real fast, guys. All right. Let me go to the end real fast. All right. Boom. Let's go here. All right. Real quickly. Let me kind of give you an example of fintech. What's going on, guys, on the fintech platform right now? That wealth transfer is you have a lot of banks like Wells Fargo, Chase, Bank of America, and also some regional and small banks. What they're doing is they are constraining their operations and closing down the brick and mortar operations a lot of times as well, because of the fact that no one goes to the bank all the time. They do a lot of their business from what? The phone. The same thing is happening in the insurance industry, health, as well as regular shit, auto, home, life, things of that nature. What's happening, guys, now, right, is you have the state farms and farmers insurance are copying the same constraint model that the banks are doing, right? So they can actually cut down the expenses, right, but increase their profit margin. And they're going to bring their licensed agents into one spot, right? One spot. So that what that does, that allows for a business model to be created for people like you and I to take advantage of, to be able to partner with them and pass on the consumers to those live agents. And you get paid a commission. Let me give you an example. Or commission. What if you can get paid up to 4% every time someone pays a mortgage? A mortgage, pays a car note, pays auto insurance, homeowners insurance, opens a bank account, pays with their credit card, buys health insurance at a 50% discount rate. Do I have your attention now? This is the fintech model, and they are pushing essential services. If you want to know a little bit more about this type of model, guys, do one of three things. Below, click on the link below in the show notes, right? And go right to it. It's free information, and it's free. Or DM me the word mentor, and my team will get it out to you today. And then last, you can also scan on the QR code right here on the screen. It's right there, guys. You go right to the free information. It's free. If the model it's not good for you, it is what it is. But I can tell you right now, there's going to be two people that actually going to exist after this whole wealth transfer. Those that are glad that they did, and those that wishes they had. This is going to be one of the biggest wealth transfers in the history of mankind. If you don't believe me, look at AI. All right? Really easy, guys. All right, guys. Also, guys, we are also giving away a free distressed property ebook. I always say you make money in real estate when you buy, not when you sell. Selling is icing on the cake. And you buy properties below wholesale. These are called distressed properties, guys. It's a free ebook, guys. We go through a strategy in this ebook, right? Of how you can get a list of distressed properties, whether commercial or residential, for free from your city. It is detailed in this ebook, and it's free. It doesn't cost you a dime at all. All right, guys, you get access to the free ebook. Very simple. And there'll be also an offer if you want me to walk you through the ebook line by line. But there's also an offer for you for it to be happening as well. Also, when you go here, all right, you can do one of three things. DM me the word real estate, right? Scan on the QR code right here on the screen or on the show notes below. Click on the link, go right to it, guys, and go download the free ebook. And if you want me and Cliff to walk you through this ebook line by line, there's also an option for that to be happening as well also. All right, guys? It's very simple. But guys, also every Thursday at, I'm gonna get rid of this real fast. Every Thursday, guys, at 8:30 p.m., I have a podcast called the Counter Move Podcast, guys. I'm gonna go through two podcasts. They're basically the same thing, guys, real quickly. Gotcha. Let's see here. Let me give you a little taste of what we're talking about. Here we go.
Why they party? I'm in here grinding. Money I'm stacking. Why they rock diamonds? I can't relate to them, ain't much in common. I set a goal for me 2 or 3 commas. 7 figures, 8 figures to 9 figures. On a slow pace to get rich quick. Same time we just think different. Cause when you make it, it hit different.
Guys, that's the Counter Move Podcast every Thursday at 8:30 p.m. Come kick with your partner. And also, guys, real quickly, we are relaunching a podcast that I did before. It's the same Counter Move Podcast, but it's called the Interview Series, guys. It's where we interview business moguls, titans, political leaders, and also thought leaders, guys. And I can welcome you in. You can ask some questions. Here's a little taste of it. Here we go. One of the many questions that I receive is, Liddell, how do I get into those rooms? Well, this interview series is just for you. So welcome to the room.
We on now. They respect us cause we on now. Money up, run the whole town, don't we? This power money can't slow down. Money won't slow down.
Guys, that's the Counter Move Podcast, the interview series, guys, where we bring on a thought leader, business mogul, or titan, or political leader probably about 2 times a month, right, to talk to us about what's going on, or what they see, what's going on in the market, things of that nature, and any type of tools we can talk about, guys. I got a special one coming up in the next couple of weeks, guys. You're going to love this person. It's going to be really good. But guys, man, thank you so much for your time. God bless you. Cliff was out handling some business for us real quick, but it's all good, baby. He'll be on the next week, guys. But you know how we ended every single time you do. Before you leave one weekend, you see that thing, I look better than you, baby. You see me looking fresh, gold, clean. Take the picture for your mom and the hot body. God bless you guys. See you next time, guys. All right, y'all. Peace. Still working 40+ hours a week and still broke. Inflation's outpacing your wages. Insurance is insane. And your side hustle just isn't cutting it.
What if I told you there was a way for you to build income by leveraging and using the exact same technology that banks and big corporations currently use right now?
With no inventory and no tech skills needed. We've helped hundreds escape the paycheck-to-paycheck trap by sharing smarter services like lower cost healthcare, competitive auto and home insurance, better loan products, higher yield bank deposits, and even ways to cut energy costs, all in one place. Take this 30-second quiz to see if you qualify. Click on the link below or click on the link in my bio.
My whole thing is, the one thing I hear a lot of the times when it comes to anybody in real estate is, I don't have the money or the credit or the time or the intellectual property. And I said, oh, okay, no problem. I have the money, have the credit, have the relationships. I'll teach you how to locate a good deal, right? You buy below wholesale.
I love that.
And once I teach you that, right, I'll bring me the deal. I help you underwrite the deal, which is fine. I'll even fund the transaction for you as well. So there's no excuses on the table at all. That's why we call that the cash flow club, period. So what happens is people always ask me all the time, Dale, can you train me? Well, I don't have the time to do that. But what if I set up a platform for it to where you get on-demand training? Anytime you want to, because the training you may need may be after you get off work, early in the morning, during the day. You just log into your account and get the same training as if I'm sitting there one-on-one. We're talking about our attorneys, our general contractors, our appraisers, as well as me, talking about how to structure your business, how to put together what they call a power team. A power team is very important. How to put a deal together, right, and buy it at the right price point. How to market. That's one technique that people don't understand. That you can actually get a list of properties that from your city for free.
Whoa. So walk me through that. Like, you can physically get buildings or homes or properties available for free?
Yeah, I'll send you guys the bill in the mail. It's real simple. What you can do is you can actually call down to your city and ask for the violations division. What happens is you say, hey, I want to see what homes in our city actually have violations. What are violations? High grass, no paint, vacant. You have boards on there. Those are actually violations that the city, or citation that the city has actually levied against that property. They'll give you that list for free. It may be a little bit of a fee, maybe $100.
Sure.
But it is what it is. Then what you do is you actually you can contact those sellers of those properties one-on-one.
Wow, and that's how you make your money. That's one way. That's one way.
If you'd like to learn how successful real estate investors make money when they acquire real estate and not when they sell it, click on the link below, swipe up, DM me the word to real estate to download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed. I'll let your partner download the ebook today.
Bless God, give thanks. Bless God, give thanks. Bless God, give thanks.